All right, welcome back. My name is Chris Sachinelli, and I get to build, buy, and sell simple, profitable businesses every single day. And today we're going to be talking about a tale of two journeys, one bootstrapped, one venture backed. And by the end of today's episode, you're going to understand the difference of what it would mean for you if you decide to travel one of these two journeys, right? So, first and foremost, let's introduce ourselves to today's character. Meet Sally Sue, right? So Sally Sue is a character that my daughter drew inside of the book on bootstrapping, and she is very near and dear to our heart. Inside of the bootstrapper community, we actually cover Sally Sue in her journey, similar as we do in the book itself, going through and mastering all the 5 exits of ownership and building value and equity inside of her business, which is Sally Sue's lemonade stand. Right. So Sally Sue is a entrepreneur, and she's made the decision to go out and build a business. And she has this job ahead of herself. She has a choice, right? The job to be done is to decide, how am I going to go and master the 5 exits of ownership, right? Everything starts somewhere. Everything also ultimately ends somewhere. And that's typically in an exit, whether we want to or not. We're all always exiting. So we might as well master the 5 exits of ownership, right? That very first exit is to exit the day job. It's where everything gets started, right? Make the business the job. And then eventually, as you traverse down this road of all 5 exits, you're going to hopefully, exit out of the business. Now, that being said, we're all moving in the same direction, and that's forward with our business, right? We all start and we want to finish, and the thing in between, that's the build. And hopefully what we're building is equity in our business, right? So hopefully we could put more profit in our pocket, both while we own the business, which is one of the things we're going to cover today, right? I want you to understand, how much profit are you putting in your pocket while you own the business, while you're building that business. And then also ultimately, once we get to that end destination and we exit, how much profit are you putting in your pocket then, right? So this is all about making a choice of how you, because it's all about you at the end of the day. And there is no wrong or right decision, right? So everything's okay and everything starts somewhere. And hopefully this video just helps you, shift or change your perspective, because if you change your perspective, you can change your approach in terms of how you want to approach, your business and building. So we have to make this decision, and the decision is a tale of 2 different journeys, right? And the 2 different journeys that we have is that of a bootstrapper, right? Taking a sustainable, profit-led approach towards building the better business, hopefully on a budget, right? And bootstrapping is quite literally that. It's the concept of starting and not really being beholden upon, or to anybody else, and being able to kind of set off on your journey and make this decision, freedom to decide, hey, I'm going to build this business. I'm going to do it my way, and I'm going to use my own resources to be able to do so. And oftentimes that those resources are our savings or the profit we already have in our pocket, right? Because again, as bootstrappers and as investpreneurs, we definitely highly promote that you go out and get a job, get somebody else to pay you, get experience, take all of that experience and some of that pay, and then start to build something on the side, get your assets to match your income, and then get to exit 1, right? Level up. It's a less risky approach to capitalism potentially, right? And a lot of what we're focused on as bootstrappers is sustainability, right? We want to take a less risky approach to capitalism. We want to build sustainable businesses that will pay us for the longest period of time, right? So instead of relying on outside money, other people's money, OPM, as bootstrappers, we're typically really focused on how do we get to profitability fast, right? And that's why with Bootstrapper Capital, we focus so heavily on getting folks to take the profit-led pledge, right? Where you can come into our community, you can go through this process and actually take the profit-led pledge, which we actually have a true pledge, I will be profit-led, and help you, hopefully set off on the right step if that's the journey that you decide to take. And then, inside of an hour, you can go through this entire exercise inside of the community to get an understanding of where you are, what your valuation is, and what your risk ratio is, and what your happiness score is, and ultimately your profitability score, value of your business, the potential equity you could build and how you can go about building that equity, right, in a sustainable manner over time. And that's us as Bootstrapper Capital trying to promote folks to become profit led or take that step in that direction. And a lot of that comes down to ownership and control, right? So as bootstrappers, we typically have the majority, if not all, of the ownership inside of our business. Why? Because we're not raising outside capital. We are our own first investors. We're investopreneurs. We're investing in ourselves and our businesses. And because of that, we have, all of the responsibility and liability that comes with it. But also the inverse of that is the control, ownership, right? We have that say of what we're going to do, how we're going to do it, and why. And that's why there's so much, at the end of the day, it's like pressure is a privilege, right? Because there's probably more pressure that potentially comes from us, right? Because we are quite literally self-sustaining, but it forces us to be able to take hopefully a profit-led approach really fast, right? So bootstrapped businesses will focus on prioritizing generating revenue or profitability really early. So you're trying to understand the market and product market fit and what customers want to buy, and you're listening, and then you're hopefully servicing that, and then you're being able to extract revenue from your activity early and often. And it's less so chasing kind of the rapid growth of ideation, right, or changing or iteration that many venture-backed businesses take. And it's finding kind of like what works, where rubber meets road, and just doing it, right? And a lot of that also comes down to resourcefulness. So as bootstrappers, we're typically extremely, extremely, extremely resourceful because it is typically all of our own capital. It's our own money, right? And it's not just financial capital, right? So as business owners, period, whether you're bootstrapping or you're going venture backed, at the end of the day, our primary job is to be the best possible capital allocator as we possibly can be, right? In my role as the owner of Simple Holdings and as the founding partner and lead investor in Bootstrapper Capital, my primary job is to be a capital allocator, right? As is yours. And it's not just financial capital. It's human capital, it's time capital, it's intellectual capital, right? Material capital, right? There's so many different versions of capital that we need to be able to take in, appreciate, and then make good timely decisions in terms of how we're allocating or where we're putting it to work inside of our businesses for us to be able to see the best possible return. And when we're working as bootstrappers, we need to be hyper efficient with that. Why? Because, when things are kind of restrained, resource constraints, right, you have to be more intentional with your approach. And that's one of the reasons why, even in today's market, venture-backed businesses kind of take a lot of this methodology, because it just takes you, forces you to kind of value the dollar a little bit more and try to get as much as you possibly can in terms of maximum benefit from every single potential decision in which you're making from an efficiencies and effectiveness perspective, right? Because of that, you're not throwing a ton of money at the wall, or you're not trying to just like dump, for example, money into, say, paid ads to grow your business or acquire new customers. You're trying to take more strategic, slower growth approaches. And oftentimes, that means having to build relationships, right? Going out and finding strategic partners in the market and doing something good for them and creating value there. And then off of that value creation experience, leveraging that into maybe a referral relationship that can replace that of, paid ads fast, right? So it's sometimes a little bit more of a gradual process, right? Like a slow grow. But I always like to think about it as like, don't think about get rich quick. Focus on how do I get wealthy for sure, right? And sometimes the slow road is the best road to actually get to the end destination, right? So that's what we're focused on as bootstrappers. And when we think about venture-backed businesses or VC-backed businesses, VC being venture capital, it's a different game because it's literally a different game. It's quite literally like, I think of bootstrapping and venture as two separate games on two separate fields with totally separate objectives, right? And because of that, they're different, and different is okay, right? Just like baseball and football are still sports, right? Bootstrapping and venture is still business, right? It's played differently. And that's because there's different motives behind it, right? And a big part of today's video is to hopefully shed a little bit of light on both of the different journeys, and then inclusive in that, allowing you to have that freedom to decide, hey, which journey kind of better aligns with my personal belief system, right? And what I want to do with my life and how, right? And the journey in which I would prefer to take. Because at the end of the day, no matter what, we know at Bootstrapper Capital, because we're actively investing in businesses, and we've done both venture and SMB, right? So we get both sides. We know that at the end of the day, the folks that are the happiest, the folks that are the most fulfilled, the folks that are enjoying what they're doing with purpose and intention tend to be more successful over the longest period of time. And that's what you're trying to do for yourself, right? Because again, as an investor, whether you're venture or bootstrapped, you are your own first investor, right? You're building this business and you're investing in yourself. So make the best possible decision for you. And the best way to do that would be to put yourself in the best vehicle to move forward. So VC-backed businesses, you're really chasing that venture velocity, right? You're trying to get into orbit. It's the rocket ship and you're trying to take off, right? It's all about scale and growth, right? So venture capital is when investors are coming in and we're raising money from other people, institutional investors, accredited investors, and they become these limited passive partners. And then it's the general partner's, obligation, responsible fiduciary responsibility to go and allocate capital into the best possible companies that will, receive the highest possible returns. So you're really trying to pick the companies that are going to really get into orbit, that are going to get to venture velocity and grow big, right? The venture-backed strategy is how do you grow the pie as big as possible? And as a founder, you're not necessarily as concerned with owning a smaller slice, right? So with bootstrapping, previous slide, I was talking about control and ownership. You're owning all of that pie, you're making the decisions, and you have the equity, right, to be able to make those decisions. Ownership, right? Think of it like you're ordering a pizza and the amount of slices you own is your equity, right? Venture capital, GPs, general partners, are investing in your business and they're trying to get it as big as it possibly can so that they can provide a return to their investors and they can raise their next fund and keep their business going, right? You, as a founder, you're selling a percentage or you're selling some slices of that pie because you realize that even if I have less slices, the pie itself is bigger and I'm still going to get full, right? And that's the goal. And the key part here is you're really trying to get that pie big. And if the pie doesn't necessarily get big, it may not make sense. And that's one of the things that I want to be able to highlight and potentially share that perspective shift again for folks watching this video as founders making this decision of venture versus bootstrapped or profit led. Because at the end of the day, you're trying to scale rapidly and then get to that exit of a goal of an exit in a venture-backed business. And what I'm going to get into in a slide here is the statistical likelihood of the milestones being achieved in either a profit-led or a venture-backed business. So when we're talking about venture, it's really about rapid scaling. It's how do we grow this thing as fast as possible? How do we put as much fuel on fire as we possibly can? Inclusive in that is accepting the dilution of the ownership. We're going to have less slices, but hopefully the slices will be bigger over time. Because we're selling the company and other people own those slices, we're giving up our influence or we're giving up our ownership. So thus investors are going to have influence in the decision, right? We're going to likely have to give up board seats. We're likely going to have a board now. We're going to have to give up board seats. There's going to be, corporate governance in which we have to follow. And at the end of the day, we may find out that even though we founded this company and we're currently the CEO, in 3, 4, 5, 6 years, we may not be the right person for that role anymore. And we may still own the business, but we may not have that job, right? Whereas in a bootstrap business, there's a really good chance that unless you get to a strategic exit 4 where you built a business system and it's exit for ready for somebody else to run, and you decide to place an operator, that job's on you, right? So bootstrap business, you're kind of trying to get yourself to be able to fire yourself. Venture-backed business, you may just find out you're not the best fit for the role and you may get fired, right? But all of it, at the end of the day, it's all exit oriented, because no matter what, we're all always exiting. It's just with a venture business, it's very clear from the beginning, hey, you're taking VC money, you're taking investor money because the goal is to exit. Whereas with a bootstrap business, you don't have that outside influence or kind of obligation, social obligation and contractual obligation, and all of these other various versions of that, fiduciary obligation, ethical obligation, to have to, exit. You can decide when and how, right? That may not be your choice. You may not have a choice or a say in the decision. You always probably have a say, but maybe not the final say when it comes to a venture business, right? That being said, they're different, but different doesn't mean bad. Different just means different. However, they're also different by the numbers. So let's look at the stats provided by the SBA, Small Business Administration, CB Insights, which has done a phenomenal job for years reporting different data and insights and metrics on the private markets. PitchBook the same, as well as Harvard Business Review, right? So on the left-hand side here, we have bootstrap companies. On the right-hand side, we have venture-backed companies. Probably should have labeled the two columns, but words shall suffice. From a breakdown, what we tried to do is break it down into the three basic milestones that we typically see in market, right? And this is the law of large numbers, right? Many VCs will very much so adopt the law of large numbers to make enough investments so that statistically speaking, their portfolio will achieve these goals and outcomes. If you invest in enough companies, statistically, the rates end up becoming the case, and then mathematically you can achieve your goals. If that's how it works, why not let it work for us? So that's how we're going to do it. And we're going to let these numbers work for us in our decision-making as we cover them on this slide, right? So the first thing that we're going to cover are companies that fail, because the reality is no matter what, as entrepreneurs, the odds are against us. And our job here is to make good, timely decisions to hopefully beat the odds, right? So that we don't end up in column or in tier number one, which are companies that fail, right? As SMBs, we know that over the first 5 years, or within the first 5 years, roughly 50% of all SMBs are going to fail. That's something that we're very passionately trying to change at Bootstrapped Capital. We want to get 100% of profit-led businesses to beat those odds, survive that first 5 years, and then ultimately go on and thrive and master all 5 exits of ownership, right? As venture-backed businesses, it goes up even higher. Probably a lot of reasons why. I'm not going to get into that in this video, because you could peel back that onion and that could be another 45 minutes to an hour, because there's whys behind everything. And like anything in life, whenever you see a stat or somebody's telling you something, you got to always ask why. Like, let's go deeper. Why? Not going to do that in this video, but you should probably go down that rabbit hole yourself. With a venture-backed business, the odds are even higher of failure within those first 5 years period of time. Once you get past the failure rate, then you're going to get into the second tier, which is a small win, right? That base hit or that double, right? And that's really all about modest growth, sustainable growth. As a SMB, you're in it, you're steady, and you're profitable, right? As a venture-backed startup, oftentimes you'll hear these things be called zombie companies, right? A few years back, we were heavy buyers for B2B SaaS businesses over at my holding company. And we would just focus on trying to find zombie startups, zombie SaaSes, and make those deals, right? A zombie startup is a company that went venture velocity and has all of the demands of being a venture-backed business, but really should have never actually went venture-backed. These were folks that were maybe offered money or capital by investors that really shouldn't have. And as maybe the founders were inexperienced or they were influenced and they made likely a bad decision, it turns out. Because when you look at the numbers and you play it forward, which we're about to in a couple of slides here, mathematically, financially, in terms of profit in your pocket, it's not a great decision over a 10-year period of time. But these are companies that they're not failures. They didn't fail, so they're not a write down situation. It's not let's shut the close the doors. They're there. They have customers. There's money coming through. There may be break even economics, and they're just not venture velocity. They're just like they're not hitting that hockey stick. They're just around, and they're not a win for the VCs, so they don't really care about them. And the founders feel all this obligation and pressure because they took outside money. They have all the obligations of running as a VC business, but none of the perks of having a profitable business. And they just keep going and just keep going and taking more time, and they're not really getting anything for it. And these are companies that hopefully, we can maybe persuade earlier to go the bootstrapped route, because these are the types of companies, those zombie startups, these are ones that will likely be better off if they actually did go profit led, right? So maybe one of the small things that we're accomplishing here in this video, or the work that we're doing with Bootstrapper Capital, is to help save some of these folks, a significant portion of their life from a potentially bad decision, right? Tier 3, those are the winners. Those are the high growth companies. And not to say that tier 2 is not a win. And even in tier 1, there's a lesson to be learned, right? So no matter what, you should always be winning, because it's a matter of perspective. And if you choose to, that is what it is. But tier 3, those are the ones that investors are looking for, right? Those are the home runs. That's where the returns are coming into the portfolio. And, very small percentage, 5-10% statistically are achieving this. And even as SMBs, the funny, crazy thing, and now that there's so many communities for bootstrap businesses and profit-led businesses, historically speaking, there was never a lot of media coverage on our space. Now all of us, because everybody went to the big, they just raised $1 billion or whatever, right? Nobody's really caring about these folks that don't have press releases going out of the fact that they're putting 10 million in profit in their pocket every month, right? We're finding now that there's actually a large number of businesses that are very successful and very profitable that just went the bootstrap route and nobody knew about. Now because we all have all these ecosystems popping up, we're starting to know from word of mouth and relationships, which is pretty cool. So it actually is happening on both sides of the table of the big winners. So there's big winners on both sides. We just don't hear about the bootstrapped ones as much because they're not in the newspaper articles, right? They're not on TV and stuff, right? They're not sitting on Shark Tank after their exit. So by the numbers, this is what it looks like. And no matter what the odds are against us, right, most businesses are going to ultimately fail. Most will fail within the first 5 years. Almost all that are inevitably going to fail outside of a macroeconomic change, meaning like, right now we have, gas cars, maybe in 10 years we won't. Anybody who's not making an EV in 10 years, may end up out of business because, macro markets change, right? Same like horse and buggy with automobile, right? So sometimes a business that survives 10 years will ultimately end up out of business because the trends are against them, the market's against them. But most of the time, if you last 10 years, you're probably going to be around. So most businesses that survive 5 years have a good chance of surviving 10. And most that survive 10 are going to be, one of these two tiers of either 2 or tier 3 businesses, right? What does all of this mean? So what does it actually mean when it comes time to putting profit in your pocket? So this is going to be a table that's fictitious. It's fictitiously done, but it's based off of actual, case studies of real numbers and growth rates, statistical growth rates of these tier 2 businesses. And in this situation, we're looking at it as, okay, we're not failing outright. So Sally Sue is not making a choice as a company that's going to fail. Because if that's the case, why make the decision? And in a tier 3, it could be skewed a little bit, but statistically speaking, most companies aren't going to make it to tier 3. Statistically speaking, if you're successful, you're going to likely be a tier 2 business. So tier 2 is, again, modest growth as a profit-led sustainable business or a zombie startup. So we're going to be looking at the numbers as a statistical odds of a tier 2 business, because that's where the most consequential decision for most folks watching this will be. So that's why. Ask yourself the why. That's the why, right? In this is profit in the pocket. So this table is showing profit in her pocket of Sally Sue over a 10-year period of time. And what we're really looking at is a salary versus a profit share perspective. And, there's a why behind that. So typically when you're raising the venture money, you're going to get put on a salary. That's one of the cool benefits of raising venture, I guess, early is, okay, great, I'm building this business. We're not generating enough revenue yet. And, I know I'm going to be able to collect at least a paycheck, right? Whereas sometimes bootstrap, that's not the case. In Sally Sue's situation, she is situating where as a VC-backed company, she's getting a 100K salary to start in year one. And then she's getting like a standard 5% incremental to her base salary, every year thereafter. Now, when we're looking at the profit-led total comp, she's getting a 50%, so 50% less of a base salary that she's paying herself, which again, that's coming out of savings, but it's there. Maybe she did a small debt round, to be able to service that. But she's paying herself 50% of what a VC business would be making, a salary would be making. But she's also owns 100% of the business, and she's able to take a profit share from the business, right? So when we're looking at the VC salary versus a profit-led total comp, that's what's included inside of the profit-led total comp. 50% of the base plus the profit share. So VC base salary is pretty standard, pretty clear how to add the 5% incrementally. Profit-led comes back from the revenue growth, right? Now, when we're looking at the VC-backed revenue versus the profit-led revenue, even though this is a VC-backed zombie startup, it's still VC-backed. So there's still an accelerant to the revenue early and often. And in this situation, the revenue is growing by 1.5 times what it is as a profit-led business. It's growing 20% as a profit-led business, growing 1.5 times that, 30%, as a VC-backed revenue business. So a noticeable difference you'll see, especially over a 10-year period of time, in terms of overall growth rate of the two different businesses, right? And that's important to notice. You're going to have more revenue as that VC-backed business in this case study example, right? However, when we're looking at the total comp, year one, she's making more VC-backed salary. Year two, more. Year three, more. Year four, more. However, in year five, what you see is this shift, right? So 5 years in, bootstrapping as a profit-led business, you see this shift. The revenue is roughly $50,000 versus roughly $500,000. However, that profit share starts to really kick in, and she's kicking in a increase of total comp, and she's actually putting more profit in her pocket starting year five. And if you continue this, even though in year 10, it's almost twice as much revenue, right? Or it is more than twice as much revenue. Even though there's a significant gap in revenue, don't do public math, the profit-led total comp is almost 100K more, right? So 155 versus 232, almost being like a rounding error of what's 20 grand between friends, right? But significantly difference in terms of total comp profit in your pocket, right? This is from a comp perspective, which you got to keep in mind. You're mastering the 5 exits of ownership, and it's a journey, right? So as we're going off and we're making this choice from the beginning, we got to ask ourselves, hey, we're doing this for a long period of time, right? This isn't going to be over tomorrow. How much profit am I putting in my pocket while I own the business, while I'm in control of the business prior to exiting the business, right? And from year 1 through year 5, yeah, she's making a little bit more, right? She's making a little bit more, but it's not that big of a gap. The variance isn't that great. So the moment in time where she's making more as VC, it's only slightly different. And I should have probably done a percentage variance, hindsight, in terms of this. But then when you start to see this shift take place, it starts to become a pretty exponential gap, an exponential difference in earnings, profit in our pocket, right? Well, that's profit in your pocket. That's the income you're taking in. What about the equity? What about that sweet, sweet equity, right? Everyone's always talking about equity as that wealth building tool. How do we build equity, right? Build equity to unlock capital. So this table is showing the equity and exit value. And the distinct, the difference of distinction between the two scenarios between VC backed and bootstrapped or profit led is the dilution or the ownership of equity. So in Sally Sue's situation, because she decided to go, VC route, venture velocity, she has to get venture velocity. So the accelerant of growth, because again, remember last table showed in this table as well, the revenue is growing incrementally when it comes time to the VC for the VC route. But that's because she's leveraging, tactics for, and taking the capital as an accelerant for growth, maybe paid acquisition, things of that nature, things that maybe the profit-led business owner is not able to afford to do at that moment in time, right? So you're going to see a difference in revenue. In terms of valuation, you tried to keep this super simple. So we just valued both businesses at a standard 2x revenue multiple, which if you've watched our other videos on valuations, you know that it's more complicated than that. And that's, all we used is a very arbitrary number. Don't put too much, thought or context into that, because watch our other YouTubes about valuations and how to exit, profitably in a successful manner. This is just to standardize a benchmark for market, for market benchmarking, right? We did a standard 2x revenue for both VC and profit led to get the valuation. So VC backed valuation versus profit led valuation. You'll notice, 2.5 versus 5.5. So again, more than a 2x difference in value, right? But that's value. Now you look at the ownership. This is a pretty standard dilution track based off of a venture-backed business that's going to go pre-seed, seed, Series A, and then stall, right? So, and she probably wouldn't even made it to like a Series A, to be honest. But we just wanted to do what, standard would look like. Typically, a founder is going to end up with like 15% equity once making it through all these different dilutions. Another key thing to take into account that I don't actually denote here, and it's not illustrated here, are the preferences. So when you're raising capital, oftentimes there's going to be preferences that are going to be put in to the capital in which you're raising from the investors that you're taking on. And that investor is going to say, hey, I'm going to get a preference share, a preferred share. My shares, my equity is going to have a preference of, I will get the 2x return on my capital in the event of a liquidity, right? And then anything after that, then it gets shared or waterfall down. Many times, especially these zombie folks, don't really fully understand that. And they'll look at something like this and they'll say, oh, I own 15%. I'm still going to walk away with $827,000, almost $1 million. After 10 years, not that great. But when these preferences kick in, that 827 may actually just be 27 or nothing at all, right? Probably should have showed that, hindsight again, maybe in another video, we'll go through that and show how this could really be zero at the end of the day on an exit for a VC zombie backed business. But we just want to keep it simple. So you're seeing the dilution of ownership. She's going from 100% owner down to a 15% owner in order to get that venture velocity, right? That fuel, that venture growth, fuel. The valuation is growing significantly, 5.5 versus 2.5. However, when it comes time to actually exit, because she only owns 15%, she's got 827, right? Whereas if you go over to profit led, 2.4 million, 2.5 million, she owns all of the business. That is a life-changing amount of money, right? Realistically, if you can get a couple of $1 million in cash, and maybe if this was a QSBS type of structure, and depending on, that's not the scope of this video, but maybe the way she structured it with Dynasty Trust or something of that nature, or QSBS, she may not be paying tax on that exit. She may be putting, some life-changing money in her pocket, right? You get up to 5 million in free cash, like you're good. You know what I mean? So this is life-changing. Now the white, what highlighted up here, is that moment in time again where the shift takes place. And yeah, year one on paper, she was looking good going venture. Year one, she had 520,000 of value versus 480,000. However, and that's actually not even right, because year one, technically she owned less than 100%. All right, well, maybe we'll do it as a safe or something. And, just for simplicity. Year one, she's doing decent, but then year two kicks in, that dilution kicks in, boom, all of a sudden it shifts. And that profit-led business actually had more equity at the end of the day. And even though the profit in the pocket, it took 5 years for that to shift, year two, the equity changed, right? So at the end of the day, Sally Sue needs to ask herself, based off the numbers, right? Based off the stats, and based off the approach of bootstrapped versus VC, which journey, these is a tale of two journeys, right? Which journey is a better fit for her, and why? And she needs to ask herself why, and then make a good timely decision. At the end of the day, everything starts somewhere. Hopefully things start by collecting information, taking that information in, hopefully experience of others, and then making a good timely decision, and then keeping it simple, right? Trust the process, commit to the journey. If you want to commit to the journey of building equity in your business to then unlock capital, and you do want to go that profit-led path, right? Then Bootstrapper Capital is hopefully going to be your capital partner of choice until you no longer need one. We're focused specifically on profit-led businesses, bootstrap businesses, and we want to help folks understand how to actually build equity in the business. We own a business brokerage. I own a portfolio of simple, profitable businesses through Simple Holdings. Bootstrapper Capital is one of my companies. It's also my focus, though, because my mission, I want to provide the most affordable, flexible capital of choice to small businesses, right? I want to be able to help folks, survive those first 5 years, get 100% of profit-led business to survive the first 5 years, and then ultimately go on to thrive by mastering all 5 exits of ownership. We do that inside of our community at Bootstrapper Capital. You can take the profit-led pledge. It's free, right? It gets you going. You can make the pledge. Then you get to unlock a lot of value really fast. We get you a scorecard. You'll know what your business is worth-ish, a decent, high-level valuation, how much equity you could potentially build, right? And then we'll give you a plan of how, and we'll give you the resources. Our goal is to give you the resources through a community-based approach to actually build equity in your business. And then as you're building equity and you're increasing your profitability score, which you can see in the dashboard as you're doing the actions, you can start to unlock capital, and you'll unlock extremely affordable and flexible, bootstrapper friendly, profit-led capital. Hopefully we become your profit-led partner of choice, your capital partner of choice, as you put more profit in your pocket. Until next time, trust the process, commit to the journey.